Good morning, everyone, and welcome to our wealth management webinar. My name is Mark Eady, and I run the wealth management and employee benefits businesses for Thomas Carroll. I'm delighted to say that we've got almost 100 people in attendance this morning, so thank you all very much for listening in. The webinar is live, no fire drills are planned, so if you do hear an alarm, your toaster might be on fire. If for some reason you do need to leave early, we are recording the webinar and it'll be available on our website by tomorrow at the latest. This is a question and answer session. We've already received some questions in advance, so thank you all very much for sending those in. If you have any questions as we go along, please use the question box on the control panel. If we run out of time and we're unable to answer all of your questions, we will follow up with an email reply later. At the end of the webinar, a very short survey will pop up. I would be grateful if you could complete it, as your feedback is very important to us. So today we're going to discuss how the virus and the global pandemic has affected investment markets. The session will be hosted by Craig Butler, Thomas Carroll's Head of Wealth Management. Craig has almost 25 years experience in the financial advice world. He's a chartered financial planner. He's a fellow of the Personal Finance Society and an accredited member of the Society of Later Life Advisors. And I'm absolutely delighted to say that Craig is joined by Chris Fleming, who is Investment Services Director at Square Mile Investment and Research. Square Mile manage our Thomas Carroll Wealth Management portfolios and under one of the city's leading investment research companies. Chris has over 20 years investment experience across both institutional and retail markets. He's a member of Square Mile's portfolio management team. He sits on the Tactical Asset Allocation Committee and is a specialist in strategic asset allocation models. Chris holds a degree in mathematics from the University of Canterbury in New Zealand. He is a CFA charter holder. Outside of work, when he is not providing a taxi service for one of his 3 children, Chris plays league cricket, golf, tends his lawn, and watches the Crusaders play rugby on Sky Sports. So once again, thank you very much for attending this morning, and I will now hand you over to Craig.
Mark, thank you very much, and good morning, everybody. As Mark has already suggested, we've already had a number of questions come in from the audience over the last couple of days. So our plan is I'm going to be asking Chris these questions on your behalf. So lots of questions to get through. So I think we'll dive straight in. So Chris, if we can start with maybe just a general overview of investment markets. So could you maybe give us your thoughts on the effects of COVID-19 on investment markets throughout the pandemic? And I guess probably most interesting for our audience today is how this links with the economic data that we've seen published. Obviously, we've seen lots in the press about economy shrinking, maybe growing a little bit in August. It'd be interesting just to take your initial thoughts on how investment markets have reacted throughout 2020.
Okay, thanks, Craig, and hello, everybody. I hope you're all doing well. To answer the question in a nutshell, the virus had an impact on the economic figures we see and also the investment markets in quite a profound way. If we can roll back, it's now mid-March when the markets sold off to the heaviest, and I'm talking equity markets here for the time being, where there were falls of between 30 and 40% across the board. And at that point in time, we're very much in the eye of a storm, and nobody really knew what was going on because nobody had experienced anything like this for 100 years since the last pandemic swept around the world, really at this level. But it's also important to note that it wasn't just the equity markets that sold off during this period as well. It was also government bonds that sold off, and that's quite unusual because normally they act as your diversifier in a portfolio. And during this point in time, everybody was running around wondering where they were going to raise cash to shore up their bills, and so are selling any form of liquid instrument they possibly could. This meant selling off US Treasuries and UK gilts, and yields moved out, which means that the price of those bonds fell quite significantly. Thankfully, this was fairly short-lived, and in terms of the bond market, business resumed as normal shortly afterwards, as everyone realized that we weren't dealing with a credit crisis like 2007 and 2008. It was just a mere global pandemic. So liquidity was still in the market, banks weren't going bust, and so people could still raise finances and move on. So the oil was still in the engine, so to speak. Corporate bonds, just to cover another part, so bonds issued by corporations, they fell in value quite sharply as the risk associated with lending money to corporations pushed out quite a long way. And if you look at the higher end part of the bond market, that was significantly impacted as yields went out by almost 10%, which is unheard of, and that means that the prices have fallen quite significantly as a result of that. Q2, complete reversal. All of this came back around, and all of a sudden we were dealing with something where there was no such thing as a pandemic in terms of what was happening in the investment markets. Markets were flying through the roof, and we had a V-shaped looking recovery, at least in the equity markets themselves. And the same happened in the corporate bonds. So all assets went up across Q2, which is quite significant. This leads us to today, where actually post Q2 and during Q3, I would say markets have been what I'm calling anyway, just been sitting in a holding pattern, not really sure which way to go, and awaiting a little bit more news to come out in various quarters, which I'll cover a little bit further afield. I guess the key question though is, how does this link to economic data that we see? Everything we read on websites and our papers and things is pointing that everything is doom and gloom in the economy. GDP figures were the worst seen, I think, when they announced the Q2 numbers, the worst in the UK at least for 300 years. They were down 20%. And economists are expecting that number not to get recovered until the end of 2024. So quite a recovery. So what has it been that's really made the investment markets strive ahead on the back of all that information that we're seeing? And there's more economic numbers that are out there that are equally as bad as well. And unemployment figures furloughed in the UK, and of course the biggest market in the world being the US has had some terrible numbers. I think what's driven it ahead is that, first of all, markets are forward-looking indicators. They're taking all this information together and saying, what do we think is going to happen in the future? And also on the back of that, there's also been huge amounts of stimulus supplied into the economy around the world. I don't know what the end number's been, but it's in the tens of trillions in terms of what's been supplied from the US, Japan, UK, the European Union, and across the world. That has provided a tailwind to all markets around the world. In terms of monetary policy, we've also had loosening fiscal policy. So for the first time that I can recall, that we had governments and central banks operating together to provide some tailwind, and that's really helped the riskier parts of the markets, at least through Q2. I'll touch on the outlook further into our presentation, but and I think that has done a good job to date. It'll be interesting to see what is going to be required to push the markets forward for 2021. So there's also been some nuances in that market as well. The US market, which I'll touch on more, is being heavily driven by 5 mega cap stocks. And I'll leave that at that point for the time being, and I'll catch up a bit further on in our discussion on why that's significant as well.
Great, thanks, Chris. So I suppose that there are areas of the economy that obviously struggled to much greater degrees. Certainly in the UK, we hear a lot about hospitality sector, the arts, airlines, etc. So clearly, COVID-19 has fundamentally affected some sectors more than others. Do you think that's going to have a long-term impact on investment thinking, Chris?
I do. I think we are doing things like this over webinars, and all of our client meetings are now done over webinars. We're no longer sitting in our offices doing this stuff, and large parts of the economy are simply not operating anywhere near what they were 9 months ago, and no one foresaw that happening. It's had significant effects on terms of the construction of some of our, what you call the indices that we look to reference when we're doing our investment. Just as a matter of interest, the technology sector has led a lot of the charge during Q2, and actually it has done for quite a while, but it really accelerated during Q2 as we were sitting at home. We were relying on technology more. We're getting things delivered from Amazon, Tesco's, Asda, Sainsbury's, whatever. I know every day I'm sitting at home, something new arrives on the porch, which is my wife keeping busy in the background, buying things to keep everyone entertained. But you know, it's definitely changed the way that we are operating. If I could just flip on to I think I've got a slide here, Craig, which I was going to show how the construct of an index has changed significantly over a couple of decades at least. And this is coming from our friends at Schroders, one of the fund managers in the city, which we look to use within the portfolios. And this is showing the top 5 stocks that are held inside the S&P 500, which is the core index which we use to represent the US market at the time. And what it's showing is the change of those stocks over a period of time. So back in the 60s, things like AT&T, a telecoms a company, General Motors, DuPont, Exxon, and General Electric were the big stocks in that particular index, taking up 27%. And then as we move through time, we see things like IBM get involved as tech starts to become more important, and you see these things ebb and flow along the way. And then bam, you get to 2020 and you see 5 stocks which are all technology based, all now being the top, making up 25% of this index. Now this index has 500 stocks in it, and 5 of them are concentrated here in these 5. And in fact, I think 4 of these stocks in isolation, if you take market capitalization, are the equivalent of the FTSE 100 in the UK. Just one of them. Apple has a market cap of about 2 trillion. I think the FTSE 100 is just shy of 2 trillion at the moment. So that shows a changing dynamic in terms of the construct of the underlying indices. We expect that to continue to a degree. There's an argument to say whether these particular stocks are hugely overvalued at the moment, although they have driven a significant amount of the recovery that some of you may have experienced in your portfolios. Anyone investing in US equities would have had a good time lately in a heavy degree. But if you took these 5 stocks out of those returns, then year to date, your returns would be about 12% less than what they would have been with holding them. And if you took those out, then the US market would be behaving very similar to the European market. So these are the reason why those particular portfolios have done significantly well. In the UK, definite change. I mean, the UK stock market is the laggard, if you like, in terms of the traditional developed markets we look at. If you break the world up with the US, I've touched on. Europe year to date is flat. Japan is up 3 or 4%. Asia is up 3 or 4%. The UK is down about 17% year to date. So it is the laggard across all of that. Now, a lot of that's got to do with the index construction. A lot of oil, energy stocks, and financials, which haven't done as well as some of these tech stocks. One final little snippet before we move on to the next one. Sorry, Craig. Technology makes up 35% of the US index. It makes up less than 1% of the UK's. So it just shows you how different they are.
Yeah, great. Well, I think we'll probably touch on technology in a sec when we start to talk sustainability a little bit. Now, we've had a question come in, Chris. So it's not necessarily related to a sector, but an asset class. One of our audience is really interested to hear your views on gold within a portfolio as an asset class, and the suitability of gold. I suppose, in times of panic, there is generally a flight to safety, isn't there? So your thoughts on gold?
Yeah, it's a tricky one. Gold's a comfort blanket, I think, and a lot of people head there in times of stress. And it is actually quite a good diversifier in a portfolio. But I wouldn't necessarily be putting this is a personal opinion and a lot into a portfolio, having it a holding on its own. I mean, it's hugely volatile. I mean, I don't have a chart in front of me, but I was looking at it the other day, and I think that the price of gold has gone above $2,000 an ounce, which is the first time that has ever happened, and it's certainly escalated recently. So it is a good thing to put in a portfolio. Quite difficult to access in its purest form, but it is possible through ETF structures. But it's one of those things that normally, if you look at an investment, you try to estimate how much you think it's worth based on what's called a discounted cash flow model. So you look at all the cash flows that come in and out, and then you discount it back and you get a present value, and you go, well, that looks like that, the market says that, so that's lower, so let's buy some. With gold, it's very, very difficult to attribute what its true value should be. It acts more like a currency, effectively, if you like. So it's difficult, and so but in times of stress and the hedges against inflation, it's quite a useful asset class to hold.
Thank you, Chris. Hopefully that answers the question there.
Yeah, just say in a small degree though. Sorry, just in a small amount.
Indeed. Super. Thanks, Chris. Okay, so let's look at the bond market. You've touched on the bond market already. We know throughout 2020 there have been some huge government stimulus packages, both in the UK and globally. Bond market is something, you know, as investment managers and financial planners, we've been talking about for many years, isn't it? Be really interesting to hear your thoughts on long-term effects of bond markets. It's a question that's come in from quite a few of our clients, actually. You know, the concerns about the level of government debt that is currently being accrued, and I guess also your thoughts on the impact of interest rates there.
Yeah, there's a lot in this simple little question, if I'm honest. So forgive me if I go into waffle mode. I'll try and make it concise. So yes, so the level of debt leading up into the COVID crisis, I think, on a level of national debt to GDP was around about 80%. I think that has gone up to 100% with all the level of stimulus that's been applied within the UK, and I think including what happened previously with the quantitative easing and what they've done now, it's about 750 billion. I think I might have that number wrong, I might be misconstruing it, but that's my understanding of what that number is. There's no reason, however, that debt level can't go higher. I mean, it is a significant number. The UK in the past has operated at that level, being at 200%. Back in the 1940s, during the war, that number was at about 200%. So it is possible for that number to go higher. It has gone higher in terms of that ratio itself, but the magnitude of the debt at the moment is about 2 trillion, I think. So that's the highest that's ever been. So we've got the denominator effect there, keeping that ratio relatively stable. The impact on the bond market itself, well, they can keep servicing this debt because interest rates are so low at the moment. So the yield on a government issued bond, which is how one means that they use to raise finances, is at 0.2%, and at certain parts of that maturity is actually negative. It's just under zero. So the UK government has done a really good job over successive years of issuing its debt at longer maturities at low interest rates, which means that it can keep servicing this at these reduced levels. If you look at something called duration, which is the average maturity of all the debt that they have, the UK is about 15 years, I think, whereas the US is about 6 years. So they've got to pay that debt back a lot quicker. The other interesting thing is that if we look globally around the world, Japan's level of debt to GDP is about 225%. So it's more than double what the UK is, but we know that they've been in a stagflationary and pretty dull environment for decades now. Italy is well above that as well, and actually the International Monetary Fund is expecting the average levels to be about 120 across the whole globe. Now, averages, lots of things can get mixed up in an average, but so I think that the UK can continue servicing this. I wouldn't be surprised if they're going to require issuing a little bit more. Another technical point is that since we're issuing and we have our own currency, it makes it a little bit easier for countries like the US, Japan, and ourselves to be able to issue debt in our own currency, because we can then turn to the central banks and go print more money. Whereas somewhere in the European Union, let's say, let's use Greece or Italy as an example, they've got to rely and borrow that money and then pay that back at some point in the future. So those countries I mentioned have a little bit more flexibility and be able to to raise those levels of finance. I guess this then ties back into what happens to bond yields. Well, bond yields have continued to fall, which means prices of government issued bonds have continued to go up for years, but the level of debt has gone up. So there is, the correlation doesn't kind of make sense. You'd expect it to work the other way around, that people would feel that it's riskier to lend money to the UK because of this levels of debt that they've got. So that hasn't happened to date. Now, what will become interesting though is what happens when inflation starts to come into the market. Now, one way which the government could erode this debt over time is to let a little bit of inflation come into the market. That therefore makes the real value of the debt that they've got become smaller, and they can get rid of it. And it's what happened post-war when they reduced those large levels of debt. However, what normally happens is a central bank, when inflation starts to come into the market, raise interest rates, which therefore makes servicing the debt harder. So there's going to be a bit of a playoff, which is going to need to happen over time, where the debt gets to the inflation levels, they might let that run up to a manageable level, let's say a couple of percent or something like that, before looking to maybe push interest rates up further into the real long term I'm talking about. So yes, it's quite an interesting little question within that. Just to pick up on the final point you mentioned there, Craig, on interest rates, will they, I guess, go negative? I guess is the implied question and what that means. And we saw the central bank's head the other day, his name escapes me at the moment, send letters or talk to all the core banks within the UK on are they prepared or how would they react if interest rates did go negative. I don't know what sort of a signal that is, but the bond markets have already anticipated that, with yields being quite so low, I would say. L&G, listening to a conference from them the other day, put the probability at about 30% of interest rates going negative. So it is a possibility, clearly.
Super. Thank you, Chris. Okay. Just before we move on to question 4, I'm going to give you, the audience, a bit of a heads up. After we talk sustainable funds, we're going to be coming to you, and we're going to be taking some views from you via a poll. So get your fingers ready on your laptops or your tablets or wherever you happen to be viewing us from today. But Chris, I want to talk about sustainable investing for a minute or so, if we could. And
yes.
A subject matter that I know is very close to a number of our clients' hearts. Sustainable funds do generally seem to have performed quite well during the pandemic. Briefly, can you tell us why you think this is, and I guess, is sustainable investing going to become a bigger discussion area going forward?
I'll take the second part of that to start with, if okay. It is very much going to become a bigger discussion going forward. We have got governments talking about this around the world, and if Biden gets in power in the US, he's very much got a policy heading in this direction, more so than the other chap, Mr. Trump. So we've got that at that level, growing interest, and I focus on the US because it's a big market. It's still the best one. That's not the best one. Sorry, the biggest one in the world. We've also got all the asset managers, all focused heavily on this within their processes. So when they invest in the underlying stocks or their corporate governance processes, it's all a bigger significant part of this as well. And we've actually got clients, as you said, asking us at a lot of different levels and what are we doing in this space as well. So there's stimulus or tailwinds, if you like, from a lot of different places. Now, I remember 20 years ago when I was a consultant at Hewitt, it was talked about and people liked the idea of it, but nobody really did it. If you know what I mean. It was almost like, we kind of like the idea of it, but traditional ways of investing, if I can call it that for a second, we were worried about not making money effectively. Now, it's very different now because, as you pointed out, those particular stocks had done quite well. Now, I'm not saying that they're going to do better than the other way, but I think there'll be a convergence where all this thing just becomes the same. There is no differentiation between sustainability stocks, green stocks, and whatever you like to label them as. They'll become unique and the same thing. And it's very much the way that we're thinking about things as well, as the evolution of our portfolios. We've got sustainable ones, we've got our core ones. They'll just merge and blend to become the same risk-adjusted portfolios with the same sorts of stocks in time as more funds come to the fore. So why have they done well over, particularly during Q2 or Q1? It's mainly because of the biases that they have within the portfolios. It's not because of the label themselves. There's been a prolonged period, if I'm going to bore everyone for a minute, that value-orientated stocks have not kept up with growth-orientated stocks. Now, a growth-orientated stock is one that, instead of paying out dividends and so forth, reinvests its money back into the company and, with a great idea, and looks to accelerate quicker than the rest of the market. Now, a lot of these stocks are quite small, so they tend to focus on that. They sort of fall into that camp, if you like. They are more heavily involved in technology traditionally, and pharmaceuticals. So that's where a lot of the development has come. And you think about wind farms and all that, there's a new technology advancement, and those sorts of things have done better over a period of time relative to the other parts of the market. You think about oil and financials, which haven't done quite so well. So on a relative basis, that's why they have done reasonably well over that period of time.
Fantastic, thank you, Chris. Okay, audience, I gave you some warning that you were about to have a part to play here. So we're about to launch our first poll. So what we'd really like to understand from you is what changes, if any, you've made to your portfolio this year. So let's have a think about whether you've not made any changes at all to your portfolio. Maybe you've moved into cash, maybe you've moved more heavily into equities, or have you left it to your financial advisor as a financial planner, which answer I'm hoping for. So we're just going to give that poll just another 15 seconds or so, and then I'll share the results with you. So most of you have now voted, so I'll give you 10 seconds. Okay, so results from the poll. So we asked if you hadn't made any changes, if you'd moved into cash, more heavily into equities, or left it to your financial advisor. So 50% of you haven't made any changes to your portfolio this year. 35% have left it to your financial advisor as a financial planner. I congratulate you on leaving it to your financial planner. 8% of you have moved more heavily into equities, and 6% of you have moved into cash funds. So thank you for your views there. Chris, tell me what you guys have been doing in Square Mile this year.
Well, we have made some changes.
Indeed.
But it depends when you think about it. We've made a series of changes along the way, actually. I mean, the portfolios leading into the year were holding a little bit more cash than usual, and that would have helped as the market sold off. We then have looked to drip feed money back into the equity market as we felt that things stabilized along the way. Now, what I mean by stabilized, I was talking about that eye of the storm, like at the end of March, where things sold off in a couple of weeks and 30 or 40%. And we certainly didn't get the bottom of that, because who knew what was going to happen at that point in time? Completely different position. And then the market rallied quite quickly. And you know what? We didn't get to complete all of that either, but we have entered into the market when the FTSE was at about 5,600. And to the order of 3 or 4% across the majority of our portfolios. But so we have reduced that cash position over the last 2 quarters, actually, but not just into equities. We've also added some, what I would say, more credit into the portfolio, so some more corporate bonds into the portfolio to perhaps ride on the wave that I was talking about before. We've also rejigged, if you like, the deck chairs a little bit. I mean, it's not just about the asset classes that you're investing in, it's also the sorts of funds that you're investing in within those asset classes. So one of the themes that we are looking at or have looked at over the last couple of quarters is passive investing, which is effectively when you just take what the index is doing. Now, we don't think that's necessarily such a good thing to do at the moment. It's good on a cost perspective, but you're effectively taking that allocation that the indices provide to you. So in the US, for example, you'd automatically be buying 25% of those stocks that I was talking about before, and in the UK, you'd probably be more heavily involved in oil and the financial sectors. So we have taken some of the massive money away from our passive investors and added to active managers, but active managers that we would consider to be defensive and look for quality holdings. Now, you could say, well, we expect all of them to be quality, but it's a bit of a terminology which is used for those companies which have strong balance sheets, be able to withstand a little bit of a shock in the system and withstand with lower levels of sales. Now, they're duller and more boring than what you would expect from those tech stocks. They're not going to keep up with that. But when the world with so much uncertainty, we'd much rather tiptoe through that by having those sorts of funds, which those sorts of funds and holdings in the portfolio over a period of time. One final point, we don't have gilts to a degree in the portfolio. We prefer US Treasuries because the yield is higher in US Treasuries, and we hedge out the US dollar to sterling exchange rate risk in that process. So that's some of the things that we've done in the portfolios, but we are looking for more opportunities. It's an incredibly busy time when markets are moving around. I think before I came on the call today, the FTSE 100 is down 2.5%. So it shows you how volatile things still are.
Well, thank you for that, Chris. I'm sure we'll all be thrilled to hear that the market is down 2.5% today. We have had a question here. It's I suppose, maybe partly related to what could happen in the future. One of our audience is really interested to understand your thoughts on the crypto market and whether you ever see that as holding a part within a balanced portfolio as an investment strategy.
I'd say not in the short term. I think that it's too nascent and it's too risky. And yet you can probably make some good returns, and people have with Bitcoin and some of the other ones over a period of time. But it's not something we are actively looking at to include within the portfolios. We also invest in funds, so we're not investing directly in securities. So this is a fund-to-fund collective. So it's sort of out of our remit to consider in the first place. So which way I'm probably sounding a little bit vague on exactly what our views and opinions are. But my gut feeling is, well, not my gut feeling. I know we wouldn't hold it in the portfolio for those reasons. It's got to be in a pooled fund environment. But I find it difficult to understand exactly what's going on within that market and what drives it, what makes it go up and down, other than lots of people getting involved and somewhat speculative, if I can say that without being crass. Yeah,
super. Thank you, Chris. Well, look, Everett, thank you for coming along with us. We've got two final areas to look at. So there is going to be one final poll after we cover the next question. So again, get your polling fingers ready for me if you could. But Chris, let's talk a little bit about commercial property, and is it still a viable asset class? And I suppose the backdrop here, there's probably two issues, isn't there? Prior to the pandemic and the sell-off we saw in markets in February, March, we were seeing many property funds being suspended as a result of liquidity. And now obviously many more of us are working from home as we are today. So yeah, your thoughts on commercial property within a portfolio?
From a purist point of view, and what I mean by that, I guess, is from a quantitative point of view, it's actually a really good diversifier in your portfolio. It does something different from a bond, a bit different from equities, and so it actually adds a little bit of something in a portfolio. It's just really tricky to deal with when it gets gated and closed like it has, because you're suddenly trading on a part of the portfolio that you can't access. And that's what happened. And I understand why the asset managers have to do that. They have to protect the interest, and they don't want to run on a portfolio and sell massive chunks of property at distressed prices. So I can sort of understand, and we haven't held it in our portfolios for 2 or 3 years. I mean, we used to, but we haven't for 2 or 3 years, if I'm honest, because we felt that the yield wasn't attractive enough to offset those sorts of risks. Now, the other thing about the property market, yes, the office space is a little bit stressed, right? I don't think many of us are in the office at the moment. You know, our office is in London, and I know the people that have gone in there so far that, you know, it's deserted. And then I know we're talking about what we're going to do when our lease runs out, which is in a year's time. What are we going to do? Are we going to have so much space? Now, I think that part of the market is probably going to struggle. However, property in itself as an asset class, and what you would invest in, say through one of the managers like L&G or F&C or BMO, whatever they're called now, is made up of lots of different component parts of the market. You've got office space, you've got industrial, you've got retail parks, you've got the big one, which has done particularly well, is those service centres on the outskirts where I can't think of the name of them now. What are they called? Retail space where you look at service space and things like that. Think about Amazon, for example. They distribute all the stuff all around the place. You can't get hold of those sorts of sites to rent them because they've been all taken up by distribution centres to try and get things out to everyone in a quick way. So those parts of the market have done really, really well. So I think what we'll see in the asset class when we come out of this is that the construct of the underlying funds that you invest in will look very, very different. You'll probably be a smaller component to office space for a period of time and a larger space in these particular parts. So I think the construct will be different. You know, there's also some regulatory challenges which are being discussed by the FCA at the moment in light of what's happened now, but also when the Brexit announcement, I think a lot of the property funds gated there, and that was in 2016. And then the previous time they did it was in 2008. Now, a lot of the property funds, the problem is that they're trading with these hugely illiquid things. It's not like an equity or a bond. You got mammoth office spaces that they're trying to deliver, and yet people want daily liquidity out of it. It's a very, very difficult thing to manage. So what they're looking at the moment is possibly introducing a 3-month period before you could get your money out of that particular asset class. So if you can withstand that sort of, well, it's not a lock-in, but, you know, a more illiquid approach to running those funds, then they probably wouldn't close. You'd be able to get your prices more frequently because you could trust and rely on them a little bit more, but you just got to withgo not getting your money back immediately like you would out of a normal fund, for example. So that's still going through and being discussed at the moment. I don't know what the outcome is yet, but I wouldn't be surprised if they change the structural nature of which these funds need to run in the future.
Super, thank you, Chris. Right, audience, you've got your second poll coming up. So this is going to be a 50-50. There's no sitting on the fence with this one, albeit I would suggest that Chris's answer may sit on the fence a little bit more. So we'd simply like to know from you, do you think that your portfolio in 2021 is going to go up or is it going to go down? We'll give you just 30 seconds to answer that if we could. And just while you're all voting, we've had a couple of questions come in from the audience, both of a very similar nature actually, around plans for retirement. And a couple of our audience today are retiring in the next 2 to 3 years. And you would like to know from Chris and I whether you should be maybe delaying your retirement or whether markets will recover. We'll just give 5 more seconds. Almost all of the votes are in. Super. Okay, so the poll is closed, and the good news is we have an optimistic audience on the phone on the webinar today. So 56% of you think that next year your portfolio will go up as opposed to go down. 44% of you think that maybe your portfolio will fall next year. So Chris, we have an optimistic audience. Are they right to be optimistic?
I think I'm going to do exactly what you said, but I'll maybe get there. So I'm going to take the average of that answer. No, it really depends on 3 things in my mind, which way markets will go. The first one, which I'll touch on, is the obvious: a vaccine. If that comes out, which I'm reading, there might be something imminent in early March next year, or at least throughout 2021. I think that'll have a huge impact on economic activity, and I would expect the markets to move forward ahead of that, where they can find that sort of information out. So that's the first one. I think that's the most obvious one that everyone will be thinking about. The other one is, if that doesn't happen, it'll be how much stimulus is applied back into the markets. So the US was due to apply some more stimulus, but have since halted on that decision. I think the UK is primed to do some more as well. I mean, you know, the stimulus can be applied in lots of different ways across the market, but those two things, and that will help stimulate the economy, obviously, which will help propel, I think, the equity markets further forward. So that's another part of it. The other thing is, just to quickly touch on, is that we are investing in a balanced portfolio. So you will all have varying degrees, I think, of risk within your portfolios in terms of how much equity you're taking. There is also the bond part of the portfolio as well. And the final one is the US election results. Now, we might sit here and think, you know, so what? But given the US market has driven so much of the returns experienced across the global equity market, what I was saying before, they're can't remember the numbers I suggested before, but they are up 18% or whatever from where they were at the start of the crisis, whereas the UK is the polar opposite of that, down 18%. It's important, the US elections and what could happen. And this is a little slide here which Craig popped up, which is from L&G and their views on what the implications could be on various asset classes. So if we get a clean blue sweep, which is the Democrats holding both houses in the market, then we expect, or L&G expect, equity markets will come under struggle. Now, the reason for that is because Biden is more pro taxes, is likely to push those sorts of things through. He's going to spend more money, and the gut reaction will be from the market, so it'll probably sell off a little bit. The other significant point with this is that he's also raising an agenda against these large tech companies and almost treating them like their own individual countries. And so if that happens, I expect those stocks might sell off a little bit as a result, which will pull that whole market down, given the fact that it's 25% of it. If Trump stays in with a clean red sweep, actually we think that'll, well, L&G think that'll probably be quite pro equities, because he'll be pro making the economy look good and keeping equities driving forward. So there's a complicated nuance here between what will happen with these, with outlying reason. My gut feeling, if I can get off the fence now, as I expect, we won't see significant levels of return like we would have experienced during Q2 or even during 2019, where we saw every market go up in double digits, all equities and all bonds. I don't think we'll expect to see that next year. I think it'll be probably still a bumpy ride as these announcements come up. We'll expect volatility to remain within the market for foreseeable future, but I do expect things to trail up a little bit. So I guess you could say I'm not far off what the pollers have suggested, that we expect things to go up, but not significantly. So we are investing in equities at the moment, looking for opportunities as well.
Super. Chris, thank you. And thank you for not sitting on the fence. It's appreciated. I think to answer the questions, it's probably one for me to answer. I probably should answer at least one question today, Chris, shouldn't I? From our audience as to whether you should be maybe delaying your retirement, or do you need to be changing your plans? I think this is the time that you really need to be sitting down with your financial planner. We need to be putting together a very clear and thorough cash flow forecast, really thinking about what you want to achieve in retirement, what sort of income do you need, where is your portfolio now, where is it likely to go over the next couple of years, and is it going to achieve what you want it to achieve? So no, I don't think you should be postponing your retirement, but certainly you need to be engaging with your financial planner, as I'm sure you are, on an annual basis to ensure that you are on track. Chris, thank you very much for answering all of our clients and our audience questions today. It's very much appreciated. We do appreciate your time. To everybody that's attended, I really appreciate you joining the webinar today. As Mark said at the start of the session, it will be recorded, and we'll distribute a link for the recording. We're going to be putting together a communication along with Square Mile in the next week or so, which is our quarterly investment summary, our quarterly market commentary. so we will send that to you as well. If you do have any questions that maybe we've not been able to answer today, or if there's anything on your mind or anything you'd like to chat about, then please do drop us a line at wealth.management@thomas-carroll.co.uk. Rolls off the tongue, I appreciate. But please do drop us an email, and we would love to take your questions. So thank you very much for attending. We do appreciate your time, and we hope to be able to speak to you again. Thank you. Goodbye.